Jamie Dimon just sold JP Morgan stock for the first time in 19 years. 19 years. The man who has run JP Morgan Chase since 2005, who has been CEO through the financial crisis, through the European debt crisis, through COVID, through every major market event and economic cycle of the past 2 decades, never sold a single share of the bank he runs. Not one share. Until now. November 2024, Dimon sold $150 million worth of JP Morgan stock. His first sale since he became CEO in 2005. Not a small diversification sale, not a token amount for estate planning, $150 million, 1 million shares. And the timing, the fact that he held for 19 years through every crisis and economic downturn and chose this specific moment to sell, tells you everything you need to know about what he sees coming in the financial system. This is the ultimate insider, the man who has access to every piece of economic data JP Morgan collects through its massive banking operations. Who sees the loan books in real time? Who knows the derivative positions and exposures across the entire system? Who understands the credit markets and banking dynamics better than anyone on Wall Street? And he just sold for the first time in 19 years. That's not portfolio management. That's a warning signal you cannot ignore. Let me show you what Dimon sees, why the 19-year pattern break matters, and what his sale tells you about the next financial crisis. Start with who Jamie Dimon is, because context matters. He's not just another CEO. He's the most powerful banker in America. JP Morgan Chase is the largest bank in the United States with $4 trillion in assets. It's systemically important, too big to fail. When Jamie Dimon speaks, the Federal Reserve listens. When he acts, markets pay attention. Dimon has been CEO since 2005, 19 years. And in those 19 years, through every market cycle, every crisis, every boom and bust, he never sold JP Morgan stock. He accumulated, he held, he preached long-term ownership. His compensation was heavily stock-based and he never liquidated. 0 sales from 2005 to 2024. That's the baseline, that's the pattern. Until November 2024. SEC filing shows Dimon sold 1 million shares at approximately $150 per share. $150 million liquidated. His first sale ever as CEO. The pattern broke. And when someone like Dimon breaks a 19-year pattern, you need to understand why. The official explanation was immediate. JP Morgan's board had approved a trading plan allowing Dimon to sell shares for financial planning and diversification. The sale was characterized as routine wealth management. Nothing to see here, just a CEO managing his personal finances. But that explanation doesn't hold up. If Dimon wanted to diversify for financial planning, why wait 19 years? Why not sell gradually over the past decade? Why not take some chips off the table in 2015, 2017, 2020? His net worth has been concentrated in JP Morgan stock for 2 decades. If diversification was the goal, he could have executed it any time. But he chose November 2024. That timing is the signal. Let me show you what Dimon has access to that you don't. As CEO of JP Morgan Chase, Dimon sees the entire financial system in real time. Every day, he reviews data that provides a comprehensive view of economic health. Consumer spending patterns through credit card transactions. JP Morgan processes billions in credit card volume. Dimon knows if spending is accelerating or decelerating before government data confirms it. Commercial loan demand and quality. JP Morgan is a major commercial lender. Dimon knows which industries are borrowing, which are paying down debt, which are struggling to refinance. He sees default rates before they hit headlines. He knows which sectors are stressed before analysts figure it out. Derivative positions and counterparty risk. JP Morgan holds trillions in derivative contracts. Interest rate swaps, currency hedges, credit default swaps. Dimon knows the bank's exposure to every major financial institution. He knows which counterparties are solid and which are shaky. He sees the interconnections that create systemic risk. Capital markets activity. JP Morgan is a leading investment bank. Dimon sees IPO pipelines, M&A deal flow, corporate bond issuance, equity underwriting. He knows if corporate activity is robust or drying up. He knows if companies are raising capital opportunistically or desperately. Treasury operations and liquidity. JP Morgan manages cash for thousands of corporations. Dimon sees corporate cash balances. He knows if companies are building reserves or burning through cash. He sees liquidity stress before it becomes public. Real estate exposure. JP Morgan is a major commercial real estate lender. Dimon knows occupancy rates, lease renewals, property values, refinancing stress. He sees the commercial real estate crisis developing before it hits headlines. He knows which buildings can't refinance maturing loans. He knows which developers are insolvent. This is the information advantage. Dimon doesn't need to guess about the economy. He sees it directly through JP Morgan's operations. And what he sees in November 2024 made him sell for the first time in 19 years. So what is he seeing? Let me connect the dots using publicly available data that confirms what Dimon likely sees internally. Start with commercial real estate. This is the crisis everyone knows about, but few understand the magnitude. Office buildings in major cities have lost 30-50% of value since 2019. Not temporary, permanent. Remote work destroyed demand for office space. JP Morgan holds billions in commercial real estate loans. Dimon sees the refinancing wall coming. Loans originated in 2014, 2019 at 3 to 4% rates are maturing in 2024, 2026. Property values are down 40%. Borrowers can't refinance at current values and current rates. They default or hand keys back to lenders. Banks take losses. JP Morgan is exposed. Dimon knows exactly how much. Second signal, consumer credit stress. Credit card delinquency rates hit 6.8% in Q3 2024. Auto loan delinquencies, 5.6%. These are the highest levels since 2010, 2011. Consumers are maxed out. They borrowed heavily during COVID stimulus. Now they're struggling to pay. Dimon sees this in JP Morgan's portfolio. He knows delinquencies are rising faster than models predicted. Third signal, corporate debt refinancing crisis. Corporate debt to GDP is 110%, higher than pre-2008 levels. Companies borrowed trillions at near zero rates during COVID. Now those loans are maturing. Companies that borrowed at 1-2% must refinance at 5-6%. That's a 3 out of 5x increase in interest expense. Many companies can't afford it. They'll default or restructure. Dimon knows which companies. He sees their financials through lending relationships. Fourth signal, derivative exposure and systemic risk. JP Morgan holds $54 trillion in derivative notional value. That's not actual exposure, but it represents interconnection. When one major institution fails, derivatives link failures across the system. Dimon saw this in 2008. Lehman collapsed and nearly took down the entire financial system through derivative chains. He's seeing similar stress building now, not from one obvious source, from multiple sources converging. Fifth signal, deposit flight and liquidity stress. Regional banks experienced deposit runs in 2023. Silicon Valley Bank, First Republic, Signature Bank, all collapsed when deposits fled. JP Morgan benefited. Deposits flowed to safety, but Dimon knows this creates systemic fragility. If depositors panic, even large banks face liquidity stress. The financial system depends on confidence. Confidence is eroding. These 5 signals, commercial real estate losses, consumer credit stress, corporate refinancing crisis, derivative interconnection, deposit fragility, are all visible in public data. But Dimon sees them with precision through JP Morgan's operations. He knows the magnitude. He knows the timing. He knows how bad it can get. And in November 2024, with all this information, he sold JP Morgan stock for the first time in 19 years. That tells you he thinks the crisis is imminent, not years away, months away. He wanted to be out before it hits. But there's another layer. Let me show you what happens to bank stocks during financial crises, because Dimon knows this pattern intimately. He lived through 2008. JP Morgan's stock price in June 2007, $53 per share. March 2009, $16 per share. A 70% decline. Even JP Morgan, the strongest bank, fell 70% during the financial crisis. Dimon knows bank stocks get destroyed when credit cycles turn. It doesn't matter if JP Morgan is well capitalized. It doesn't matter if they have fortress balance sheet. Market sells all banks indiscriminately during crisis. And Dimon is telling you a crisis is coming by selling now at $150 per share instead of holding through what's coming. Here's the math. If Dimon thinks JP Morgan will fall 50-60% during the next crisis, selling at $150 means he can buy back at $60-$75. His $150 million becomes $375 million worth of stock at lower prices. Or he holds cash through the crisis and buys other assets cheap. Either way, he wins by getting out now. But here's what's terrifying about the timing. November 2024 was specific, not October, not December. November, why? Because Dimon has quarterly data. Q3 2024 earnings reports came out in October. Dimon saw the trends, and immediately after seeing Q3 data, he executed his first sale in 19 years. That suggests Q3 data showed him something that crossed a threshold, something that made him decide now is the time to exit. What could that be? Probably acceleration in the negative trends. Consumer delinquencies rising faster than expected. Commercial real estate losses higher than modeled. Corporate credit stress spreading to investment-grade companies. Any or all of these. But the acceleration scared him enough to break 19 years of holding. Now let me show you what other insiders at JP Morgan are doing, because Dimon isn't alone. Other senior executives at JP Morgan have also been selling. Not as dramatically. But the pattern is there. When the CEO sells for the first time in 19 years and other executives are also reducing positions, that's coordinated de-risking. They see the same data, they're reaching the same conclusion. Get out. And it's not just JP Morgan. Goldman Sachs executives have been selling, Morgan Stanley executives, Bank of America executives. Across Wall Street, banking insiders are reducing exposure to their own institutions. These are the people who know the financial system best. They're not buying, they're selling. That should concern you. Now, let me connect Dimon's sale to the broader pattern of billionaire exits. Warren Buffett selling stocks and holding $325 billion cash. Bill Gates reducing Microsoft 55%. Jeff Bezos liquidating $8.5 billion Amazon in 9 days. And now Jamie Dimon selling JP Morgan for the first time in 19 years. These aren't isolated events. This is coordinated flight from risk. They're not talking to each other. They're not colluding. But they have access to similar information. They see the same economic data. They reach the same conclusions. The market is overvalued. A correction is coming. Credit stress is building. Get out before it breaks. The combined insider selling exceeds $89 billion over 6 months. And Dimon's $150 million is the most significant because of the pattern break. 19 years of holding, 0 sales. Then suddenly in November 2024, he sells. That's the ultimate insider signal. The man who runs the largest bank in America, who sees everything, is getting out. What should you do? First, recognize what Dimon's sale means. This isn't routine wealth management. This is a warning from someone who has access to data you'll never see. When the CEO of JP Morgan breaks a 19-year pattern, you need to pay attention. Second, assess your exposure to banks and financials. If you own bank stocks directly or through index funds, you're betting against Dimon's judgment. The man who runs JP Morgan just sold JP Morgan. That tells you what he thinks about bank valuations and bank prospects. Third, understand that financial crises hit banks first and hardest. In 2008, financial stocks fell 60-80% before the broader market. If Dimon sees a crisis coming, bank stocks will be the first to collapse. Getting out of financials now protects you from the initial damage. Fourth, follow the playbook Dimon is using. He's not selling stocks to buy other stocks. He's converting to cash. He's holding liquidity. He's waiting for the crisis to create opportunities. When bank stocks fall 50-60%, when other assets go on sale, he'll deploy that cash. You should do the same. Fifth, recognize the timeline. Dimon sold in November 2024. He wouldn't have broken a 19-year pattern unless he thought the crisis was imminent, not years away, months away, maybe Q1 2025, maybe Q2 2025, but soon. The timeline is compressed. Jamie Dimon sold JP Morgan stock for the first time in 19 years. That's not a headline, that's a siren. The most powerful banker in America, the man who sees the entire financial system, the CEO who held through every crisis for 2 decades, just got out. He knows something, he sees something. And he's warning you the only way he can, through his actions. Don't ignore this signal. Don't rationalize it away. Don't assume you know better than the man who runs JP Morgan Chase. 19 years of holding, 1 sale, November 2024. The pattern broke. The warning was delivered. The question is whether you're listening